So, a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me on x.com/Stephen Wardell. Our show today is on the topic, Providers Are Winning Digital Health. Who stands to eat the most wedges of cheese from the digital health wheel? Payers, patients, pharma, software vendors, and providers. Our guest today is Adam Kaufman. Adam is the publisher of Bearing on Health and an adjunct professor of economics at USC. You can follow him on LinkedIn at linkedin.com/in/akaufman. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify, and we always love getting a review. And we have a new podcast page, so make sure you see recent episodes on the page and subscribe to that page and not one of our older pages. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Adam and I will spend the first half talking about news and trade journal stories and the macro picture and some other topics. And then we'll focus on our topic of the day. And we'll take your questions throughout in the LinkedIn chat. And we already have a comment from Melinda who says, the Adam Kaufman. So Adam, you attracted some fans to the show already. Adam, please welcome to the show, and please introduce yourself to our audience.
Thank you so much for having me, Linda. I'm a big fan of yours as well, so glad you're there listening. So as Steve said, I'm an economist by training. I have the good fortune to teach applied statistics in the income department at USC. I also do have a newsletter in this space. I spend most of my time these days working with Baylor Scott & White, the big health system out of Dallas and North Central Texas. I've had the good fortune to be an entrepreneur and executive in digital health, I think before we called it that. So it started with e-health and then mobile health, and have built some companies, seen some not do so well, launched a lot of products. I normally am not in a jacket, but Steve, since I knew we were talking to investors and maybe some positions on it, I put a jacket on.
Great, thank you. And I'm hearing the audio is, the volume that I'm hearing is a little low, and the quality is a little low. It's acceptable, but if you have any ability to put the microphone closer to your mouth, that would be great. I don't know if you have that, but these days people are always working off of things like laptops and that sort of thing that doesn't always have perfect audio. So, well, good. Well, so thank you, Adam. And you and I first met when you were the CEO of a digital health company, and I always thought you had a good perspective on the market. Or on the digital health product marketplace, among other things. So now moving on to our next topic, it's about macro news. And here we talk about things like stock market index levels, inflation, interest rates, jobs, unemployment. And I also welcome for our audience to ask your questions about macro issues as well. In the chat. So the first is that the NASDAQ is at 17.2 thousand, and that's down from its high a month ago or so of 18.6 thousand. And I think the market's been on edge. There's a fear that we're going to finally have a big NASDAQ correction. It could be led by a kind of a collapse of AI and SaaS stocks, leading to a major NASDAQ correction. And some people were afraid that we were seeing that literally last week and the week before, but it looks like we have not been seeing that. After all, we're seeing a minor correction in the NASDAQ, and it's headed back up. And in general, in digital health, a high NASDAQ is a good thing in general for us. It means that tech stocks are being valued highly. It means that the market's relatively risk off right now, but it means that there's no, that it should auto flip to being risk on, and we like that. It means that if you build your tech company, you can sell it to the public at a high multiple, etc. But there's definitely two tiers of being a NASDAQ company. One is the FANG stocks and AI and large AI stocks, and they've been doing wonderfully well. And there's everybody else. And unfortunately, everybody else includes digital health stocks, which are which are often down from 2 years ago or 2.5 years ago, and not doing well in today's market, even though they are software companies that sometimes have a decent top line growth rate, or at least promise that out of the gate. But all in all, from the perspective of the innovation community and young company leaders, having a high NASDAQ is a very good thing, and it could lead to our finally seeing a better fundraising environment, which is the question everyone's asking: when will the fundraising environment get better? So, Adam, any thoughts on the NASDAQ, what we're seeing, and are we going to see that correction maybe, or is the NASDAQ going to keep going up?
So even though I'm an economist, I will claim to know less about the stock market. I do pick up what you're saying, Steve, about the digital health companies. And I think, they are not doing well. And I'm not sure we'll see them bounce back. So I can't comment on the broader correction in the NASDAQ, but I think for those of us in the digital health space, the fact that those firms are not doing well, even with the market high, is not good. And I think the growth expectations that were probably priced into them a while ago have been moved. And so I think that, from a digital health perspective, we're still going to be challenged based. I apologize. I think that the recording picked up the wrong mic and I can't figure out how to change it. So I just want to check and see if you can hear me any better now. I tried to adjust it.
A little better. And I happen to know we're using the Riverside studio system, and you have to actually exit. And then when you go back in, it allows you to re-choose your microphone. And so you could do that, and I'll just
Let me do that. I think you've got some things to talk about. I'll be right back to everyone. I'm sorry about that, but I'll come back with a better mic.
Yeah, that's great. So we're in this unusual time where the NASDAQ was at highs, then it pulled in, scared everybody. Since then, it's calmed down. NASDAQ's been going back up again. But market participants have been severely criticizing the Fed. Everyone loves to sort of punch this particular Fed chairman and saying that the Fed waited too long to raise rates when inflation reared its ugly head 2.5 years ago, and now the Fed is waiting too long to cut rates. And we're seeing hesitancy and market fears going on because the Fed has waited too long to cut rates. But that kind of commentary, and in the innovation economy, we very much want the Fed to cut rates, but you don't want the Fed to cut rates too much. It has to also tackle the inflation problem as well. So you want inflation to not be a problem. If inflation is a problem, you want the Fed to tackle it well, and then you want the Fed to cut rates after it has succeeded in tackling it. So, Adam, welcome back. Maybe you were able to fix the volume issue.
I think so. I can hear you fine. Can you hear me better now?
Yeah, I think your audio is much better now. That's great.
Perfect. Good.
So we talked about how Fed commentators are criticizing the Fed now for waiting too long to cut rates, which is so unjust. And the intriguing question is the Fed is sort of on deck to cut rates this year, and the question is, typically they would cut it by 25 basis points. So the question is the Fed going to cut it 0 times or 1 times or 2 times or more by the end of the year? And it looks increasingly likely like the Fed will cut at least once, maybe twice or more by the end of the year to address these market jitters. Today, a new inflation report came in saying we have annualized inflation at 2.9% for July, slightly below expectations, the lowest since 2021 when we started having big inflation fears. And the commentary I saw on CNBC for that was that this low inflation report paves the way for rate cuts. Now, in digital health, it's very much the case that 5.5% federal risk-free rate is terrible for digital health. It's terrible for growth companies, for innovators, for companies that are earnings negative for a long time before eventually becoming earnings positive in the future. And we would like to see the Fed cut rates and get back again. So our audience is saying that you sound much better, Adam. So
good.
That's great. So Adam, any thoughts? And we want to see a return to a higher level of fundraising by venture investors in young digital health companies, and the raising of rates is what put a freeze on that 2.5 years ago, and the cutting of rates would probably bring back a lot of that investing because VC investors have the money raised. They are just being slow investing it, and lower rates would speed them up investing it. Any thoughts on that, Adam?
So first, I think you're absolutely right. Lower rates are meaningful for, digital health companies, particularly early ones. I think both in the, the investor mindset in terms of deploying capital. But I think maybe what's not talked quite as much about is most of the customers are big institutions that are paying bonds or, are subject to interest rate expense on the other side. And so I think money is spent by health systems and by health plans more freely when interest rates are lower. And so, the demand side, I think, is stronger as well. I wouldn't guess the market. I also heard, I don't know if you heard this, Steve, that maybe there'll be a 0.5 point cut instead of 2 quarter point cuts. So I think, the market certainly believes, and I think that's right to say there'll be at least one cut. But I wouldn't gamble on what the Fed's going to do, although I'm certainly hopeful they will.
And so if you cycle back to the JP Morgan Healthcare Conference in January, I think at that time, VC investors and young company leaders I spoke with, they said that the investor environment was terrible. It had been terrible for all of 2023, and they expected it to be terrible for all 12 months of 2024. And I have been taking a contrarian optimistic position, saying that in the second half of the year, we're going to see investment conditions improve by 25%. That's the metric I've been saying for a while, meaning number of small deals goes up, small sized deals goes up 25%. That would be a meaningful uptick to me. And the early Rock Health reports showed continuing tough market, but the more recent reports are showing an uptick in number of deals. If the Fed were to cut by 25 basis points or 50 basis points, I think that would definitely meet. I think we probably would see a meeting of my target of a boost of 25% by the end of the year. So very interesting, and that's becoming more likely.
Quick on that, Steve. I don't know if you saw the recent pitch book analysis that said it may be worse than it looks, right?
Oh, interesting.
Yeah. So basically, they argue two things. One is a lot of it's AI, which has had some big rounds. And then a lot of it is hiding folks who probably had to raise because they had not raised yet in not particularly attractive rounds. So I think the down round rate is higher than it's been in a long time. That's, the later stages. So I'm not super optimistic. I think the other thing that doesn't get talked about as much as well is even when there's more activity, it seems like the terms have become less, founder and company friendly. And so that's a big, you might be able to get a deal done, but if it's got a preference stack or other kinds of investor friendly terms, that's not as attractive. It's another way to sort of feel like it's happening, but it's not good news for the entrepreneurs.
Yeah, very good point. Well, good. And so then, so the next, we're going to shift to industry reports. So I think I haven't seen any particular reports come out in the last week or two. Adam, are there any that you look to or that came out recently or that have findings that you think you want to bring to our audience?
Yeah, nothing since your last show, Steve, but I did want to call people's attention to two that I thought were interesting. So I think it's from June maybe, but Advisory Board, which I know a lot of the audience will know, did a nice report on, they called it, I think, 11 things that CEOs should know in 2024. And they do a nice job of sort of hitting major trends. That was one. And then PitchBook, to tout another one of theirs, did announce, again, I think it's an early July publication around PE's role in healthcare. And I think, at least in their analysis, debunked the idea that private equity is sort of taking over healthcare, said it's roughly been at the same levels. They've been investing in the same way. And so, I think those are two interesting for different reasons, sort of things that I encourage people to look at, although not recent.
Great, thank you. Yeah, very interesting. I think there's definitely a perception that private equity is playing a bigger role. Of course, the term private equity suggests later stage investment where the product is not itself highly risky. Venture capital suggests the product itself is highly risky, whether it works or not, whether it will ever be bought by buyers. Private equity suggests that it's much more mature. You've got companies that are leaders in market share that are selling every day. There's not a lot of risk whether the product works or not. Private equity likes healthcare. Healthcare tends to be a relatively protected market with relatively high prices and relatively high margins as compared to other areas of the economy, as compared to consumer electronics is the opposite of that. In consumer electronics, there's no protection and terrible margins. Private equity doesn't get involved there. And there's been a perception that private equity is like taking over different specialties, kidney care or pain management or whatever. And so that's interesting that PitchBook has gone out and said, no, it's not, at least not compared to 10 years ago. Or 20 years
so this looked, their analysis, I'm looking at some of the key points, so specifically is actually looking at private equity in providers. So we should be specific, but I think the area that seems to be the most concerned. And their stat says less than 4% of providers by revenue work in private equity controlled companies. So, and I think they said 20 years ago it was 3%. So, I mean, obviously it's a higher amount because the amount of money going to providers has grown, but as a share, it's a relatively small amount, according to their analysis. So I don't think private equity is taking over the provider space.
Yeah, interesting. Also, if you think about it, that equity has to be held by somebody. And so who are the candidates of who it could be held by? Well, maybe like a founding family, that would be like the Frist family in Tennessee. Or it could be public, that would be like the public shareholders of HCA, for example. Yep. Or it could be a nonprofit like the Catholic Church or someone owning a hospital. Or private equity. And there's been a phenomenon over the last, let's call it 15 years, where there's a lot of criticism of taking companies public, and claims that keeping them private is a better way to go. And that has to do partly with Sarbanes-Oxley, that you have this arguably $5 million deadweight loss cost going to very tight running of rules and regulations around the finances of a public company. And then also, there have been sustained periods of time where public companies seem to have low valuations. And of course, investors always want to take their assets and put them somewhere where they'll have high valuations, such as, and so if private equity has higher multiples for a sustained period of time, and investors want to move it there. So it could be that this move from 3% to 4% of healthcare services companies backed by private equity could be in reaction to Sarbanes-Oxley and aversion to that sort of deadweight loss costs of keeping a company in a publicly traded.
Yeah. So maybe, I mean, there aren't that many publicly traded provider organizations, right? It turns out still a significant plurality of providers are small independent practices or small groups where they're essentially operator owned, right? That's still a big piece, although it's no longer the majority if you do it by employment. I don't know if it's quite the majority, but probably the highest segment of employers of healthcare providers are now the hospitals themselves. And then that's followed by the health plans. There's obviously HCA and Tenant, some of the newer companies, but providers have not tended to be entities that go public in and of themselves, these sort of professional corporations. Part of it's a structural issue. You have to be owned in most states by the providers themselves and some of the corporate practice of medicine. And private equities figured most of that out with sort of the services organizations. So I agree with you completely. I don't know if it's in this particular case a trade-off between private equity and public markets. It's more the percent that are staying small or moving into the giant healthcare providers, which I think is probably the bigger trend for providers, practices becoming part of hospitals. And I think personally the biggest trend is the plans moving into care delivery in a very meaningful way.
That's interesting, yeah. Well, good. So thank you for that. And so now we're moving on to the part of the show where we talk about business news and trade journal news of the last week or two. And we're sort of putting out a call for what is the biggest healthcare story of the week for the last week or two. And so for our audience, do you have any suggestions? And on our last show, it was the story of that security flaw that caused PCs to shut down in regulated organizations like in hospitals and airlines. And so I don't think there is one necessarily this week. Seems like it's August. It seems like a slow week in August. So Adam, do you have any thoughts as to what the biggest story of the week in healthcare is? And for our audience, feel free to put ideas in the chat.
It's not a super big one, but I was fascinated by, I think it was 2 weeks ago, Novo announced underperforming sales for Wegovy, mostly around pricing pressure. And within a week, Hims increased its guidance, given that it was compounding GLP-1 medication. So I think the combined news that, obviously Novo is doing very well with its GLP-1s, but that there is real price pressure, I think is really interesting and a big story. And the reason I encourage people to look at, not only is GLP-1s a huge category, it's disrupting a lot of the areas I've worked in around weight and cardiometabolic, but really we haven't seen a case where competitive pressure has dramatically impacted pharma pricing, right? In most cases, there's enough distinction between the drugs until generics. There's enough distinction between the drugs that they can carve out the right space and they're willing to take a smaller market share to maintain price. I've said for a while that I think GLP-1s, it's not a given, but could be the first category where the opportunity to really go after bigger markets that would have precluded the option, think Medicaid and others, may actually see us have pricing pressure in a way that we don't see in other drug categories. And at least the early signals seem to be saying that that's happening. We'll have to wait till, there's going to be 2 or 3 more branded GLP-1s in the market in the next couple of years. But I think that's a big story for the drug class, but it's also a big story of what it means within competition within the pharma space itself.
So that's interesting. I think I'm a fan, and I both like a new drug that works, making a lot of money for its maker, and I'm also a fan of competition, bringing prices down so that drugs are not ridiculously expensive as well. And so this is an interesting example of both of those happening at the same time. And I actually have some colleagues who like to joke that every single story in healthcare is actually a GLP-1 story. You can just
pretty much
sort of look at the story, look at the headline, and you can work backwards how GLP-1s are somehow affecting that. And it's rare we have such a big bowling ball dropped in the pond of healthcare, of a drug that works, that's expensive, that works, that has high utilization, that seems to produce rapid results. I hope there's no side effects, no serious side effects to the drug. Intriguing adjacent areas like using for like marijuana addiction, or use in other areas, not just diabetes and weight loss, but other areas as well. And so, I think an example would be the first antibiotics, Alexander Fleming and penicillin. That was a case of a drug having a massive societal impact, and we're living through one of those right now. So let's see. But for our audience, any thoughts as to what's the biggest story in healthcare this week? And I'll move on to I'll talk about some fundraisers, but we're still living in a time of a big reckoning for young, innovative digital health companies. We're still living in a time of more wind downs and exits and asset sales at non-favorable terms than fundraisers. In the sector, it's still a tough time. There was probably over entry for the last 15 years, and now we're seeing a sort of a reckoning facing that. So what I'll mention, so one story is that Google has just unveiled its Pixel Watch 3 with new health and fitness features, and the features include fitness training effectiveness, sleep quality, and recovery needs. And so this is interesting because it just shows continued interest of big tech. So Google owns Fitbit, among other things. It has its own Pixel Watch, and Garmin is in this market, and Whoop is in this market, and Apple, of course, is in this market. And so just continued development of feature functionality and continued emphasis of health, big tech getting into health, Apple being the biggest example, Google not far behind them. Any thoughts on? I think that's a good thing. We want innovation like Whoop coming along, and also that Ring company or a Ring, but we also want big tech to care about the sector and be acquirers and invest in the sector and advance it forward. So
and if I can tie it to the GLP-1s a little bit, I've been in this space long enough that I can clearly remember that there was a very, very bright line, and I used to say it myself, between what was a medical solution, meaning you expected to get it reimbursed by your health insurer, prescribed or referred by your doctor, and what a consumer product was. And my personal journey is I built essentially a digital chronic condition management company anchored primarily around diabetes and weight that we took to healthcare. And then I went to Weight Watchers, which was a consumer company that then was trying to move into healthcare. And I think the Google example here is really, we're blurring the lines much more than I think I personally would have anticipated. I think some of that is COVID. I think if you think about the GLP-1s, it's a good example. Weight for a long time has either been medical weight or, consumer customer weight. And the GLP-1s are the first drug that sort of fits into both in a meaningful way. And I think you're seeing this line break down in categories that are, connected to obesity, to physical activity, to mental health in a really important way. And it's allowing innovation to come out. Who's going to win in it, I think, still remains to be the question and where it goes. But I'm a big believer that healthcare needs to become more kind of consumer centric, driven by the same rigor and product and go to market as we do in consumer side. And that the consumer space should go there, but needs to do it in a meaningful way to the healthcare sectors.
Thanks. So moving on to some other stories, Adam, you were the CEO of a digital therapeutics company, and Big Health has just scored an FDA 510K clearance for its Sleepio RX product. I remember the Sleepio non-RX product.
Yeah.
This is a digital therapeutic that uses cognitive behavioral therapy to help patients learn techniques to improve their insomnia symptoms. So a couple of things going on here. The first is that digital therapeutics are very out of favor with digital health investors right now, and that has to do with I think the issues around Pear Therapeutics bankruptcy. I think it was Better Therapeutics also went out of business, and then another high flyer is that the Boston company for attention deficit disorder that exited the clinical market and is pursuing the consumer market. Achilles, yeah.
Achilles, right? Yeah.
So just disappointment by investors. We're in sort of a trough of expectations by investors right now. And so I think it's very good to see continued progress. The FDA taking prescription digital therapeutics or software as a medical device seriously, granting approval to see products be announced in this space. And I think that my thesis about this space is that it's going to look like medtech in the future because it doesn't have the IP protection or the immediate reimbursement that pharma does. It's going to look more like medtech. And I think that's a disappointment for some. I think Pear very much was insisting that the sector is going to be the biotech sector, which typically has high margins, fast sales ramps, strong IP protection. And I think that this sector is going to look more like medtech, which I think is a disappointment for a lot of us players in the industry, because we'd love for there to be a second biotech sector driven by software with the dynamism and the size of the biotech sector. But it's going to look, I think it's going to, over time, it's going to look more like medtech for the reasons I mentioned. Adam, do you have any thoughts on this particular announcement and and prescription digital therapeutics in general?
Yeah, I do. I knew Peter Hames when he was running the business, and we were both kind of early entrepreneurs in the space. And it was a debate we had, right? What is the right commercial model? Do you take a product to a consumer? Do you take a product to a provider and sort of sell it as an enabling service, or do you take it through this pathway of essentially trying to get reimbursement like a pharma? So he obviously felt strongly one way, and the company I think has done very well in the more consumer style. But it has now obviously shown that there's interest to go into the prescription style as well. We forgot one piece of news, and I feel very bad because I can't remember the name, but if I'm not mistaken, in the last week or two, CMS came out with some guidance around how it's actually going to reimburse for a small set of digital therapeutics that have been approved through the breakthrough pathway. It's very relatively limited. And again, I'm not an expert in it. Hopefully there might be some people on the call who could correct us if I get it wrong. But I think most of that is for mental health indications. So I think, for Sleepio, I think it's probably a really nice timing and a smart move. More broadly, I think you're right. It looks like medtech. I think, it's hard to get coverage for these anyway. Some that have gotten coverage have actually looked like CPT codes, so they look like device codes like medtech, so they're even getting reimbursed in the same way. And they version and the IP that's there, not only is it not 17 years, but it's not 3 or 5 years like a medtech physical device. It's 12 to 18 months, maybe 24 months. So the product structure also makes it look more like medtech than pharma, and maybe even more repeated. So I think the disappointment is the margin profile will also look more like medtech, or perhaps even worse, in the sense that a lot of these also have more of an intense service component, certainly than pharma did, and certainly than the most medtech. And so I think it's a valuable sector, but I think for those investors who thought it would scale, you get approval, get a code, scales like pharma, and see margins like pharma, I do think that'll be a disappointing model. And we need to rethink the pace of growth that will look slower than a pharma launch, and the margin profile of those.
Thanks. And Swati in our audience mentions to Adam that that's correct what you said about CMS. Most of the reimbursement is for mental health indications.
Thank you, Swati.
So next we're going to move on to our entrepreneurial audience, the topic of inflection points. So the inflection point, if you think of the sigmoidal curve of market adoption, it's that vertical part of the sigmoidal curve of market adoption. And as an entrepreneur, you want to be following inflection points, and you want to get in on trends before the inflection point happens. And so, I think I'll hold out there as an inflection point. I think we're seeing maybe AI search engines, AI answer engines replacing search engines for people, and we're near the inflection point. We're seeing an uptick near the inflection point for that trend, and I think that'll be a trend in healthcare as well. People doing health searches used to take them to 10 blue links. So those searches are now going to take them to the answer to their question. Adam, any thoughts on, do you have an inflection point that you're following that you think we're going to see, ideally we're before the inflection point, that you want to tell the audience about?
No, I wish first, I really appreciate the perspective. I think you're thinking about it right. And depending on how one thinks about a market where, again, I don't have any that I see, and it's not for lack of them being there. So appreciate the question, but not too much to add.
So next we're going to move on something fun. It's just, what is a positive, useful affordable piece of technology in your life that has helped you, made your life better, made you more productive, you enjoy? And what I'll throw out there, and this is actually building on my prior comment, is I just, in my Chrome browser, in the URL bar, the search bar, I just replaced Google search there with Perplexity AI. And you could replace it with the big guys. You could replace it with OpenAI, Chat GPT 4.0. You could replace it with Copilot. You could replace it with Gemini. You could replace it with other ones. But I replace it with Perplexity because when I look up companies and when I look up funds, it gives a slightly more structured, it gives the answer, and it's slightly more structured. It's not just I ask it a question as a sentence, it gives me a paragraph as a reply. Perplexity just kind of puts things in different parts of the page, repeatedly, and my eye is getting accustomed to seeing it presented that way, and I found it to be very good. And then someone asked me, and it's definitely faster than having a search engine reply to your search bar queries. And someone asked me, how do you know it's not hallucinating? How do you know it's completely accurate? And I realized I don't know, because I'm not doing it twice. I'm not looking at it. So maybe I'm being fed stuff with little errors in it that I don't know. But that's that has sped up my life. It means I do things, and the Perplexity seems to get its information from multiple public sources and put it all together in one answer. And that's great, because otherwise that's me going to those multiple public sources and getting one data point from one, another data point from another. Adam, any thoughts about technology that's made your life better?
Yeah, I'll share when I was smiling when you asked, because I knew you had prepped me for the question coming. But real quick on the hallucination, I mostly use ChatGPT. I find if you ask it after it gives you an answer to give you the references, I've actually had it say to me, I don't have any specific references. It's a homogenation. And I'm like, okay, well, sometimes that's okay. But if I need to know, then I'll keep prompting it. So you can actually sometimes ask them. I don't know how Perplexity works. If you could challenge it to say, hey, where'd you actually get this from? If you needed to source it. I've got a new take on an old school tech that I really, really like. I travel, particularly when I need to travel with work, with a wireless, external monitor. And so I will have a 24-inch. It fits in my backpack briefcase next to my laptop. At home, I plug my laptop into a monitor. And so this gets me close to that dual screen. It can be done wireless. It charges in the same way. It plugs in. And I just find that so much easier because I'm accustomed to looking at my calendar on one screen and other things. It's a little heavier than I would like. I don't remember the brand, but I'm sure I bought it on Amazon, and you could find one, and they're pretty good. They're not super expensive, and it really makes that office away from the home office much easier to work with.
That's great. And Swati mentions that ChatGPT is now providing links to references. So that's great. Thank you. Yeah, I'll add to that that I was on a multi-family vacation recently, and the other dad who was there pulled out one of those second screens, and it was corded. It was very light and has a single cord, not one cord for power, one for data, but one for power and data. it looked really productive, and so I went and got one by Asus, and I have found them also to be, the versions that I'm using are corded. So if you look up the Asus, second screens, they're not that expensive. And for knowledge workers, the productivity boost of having two screens when your laptop mobile is very valuable. That's great. So then the next one is upcoming conferences. So for our audience, oh, by the way, for our audience, if you guys have any tech that has made your life better that you like to use, like last week, I think my example was those Apple coins that you put in your wallet, whatever those things are called, that you
The
can
air
track.
tags, or is there a separate one?
Air tags, yeah. I got a couple of those, and those were worth it. So Swati says she has a portable monitor. It's wired and lightweight and one cord by Lepo, very cheap on Amazon. So thank you for that. And by the way, you can also, when you're there's no reason that they have to sit in your laptop bag. You can actually have them be extra monitors on your desktop, and then just pick it up and toss it in your shoulder bag when you go somewhere. So let's see. The next one is upcoming conferences. And so for our audience, if you guys want our opinion on conferences, is it worth going? Who would you meet at this conference? How do you make the most out of the conference? Would you expo at the conference? Would you actually buy a ticket or just sit in the coffee shop outside of it? Those sorts of tips. So I'll bring up, I guess first, some people in our audience will be going to the Epic User Group Conference coming right up. It's Monday, August 19th in Madison, Wisconsin. I'm actually surprised. I've run a user group conference for Patient Keeper in the past, and I would not have put mine in the second half of August for a user group conference. There's only so much loyalty you can expect from software users. But nevertheless, HealthX Ventures, a top early stage venture fund that has offices in Wisconsin, they are hosting a party for a digital health party associated with the user group conference in Madison on Monday, August 19th. So if you're one of the people going to the Epic User Group Conference next week in Madison, Wisconsin, you can find it on Eventbrite, HealthX Ventures Epic User Group Conference Party, or ping me and I'll send you the link to the event. And then Alex Fair, who's the founder of MedStarter in New York, and I are hosting a digital health drinks night, a health innovation night on Tuesday, September 3rd in New York City. So I'm Boston-based, but I'm traveling to New York at that time for the Young Startups Venture Summit in New York, which is September 4th and 5th. But our party is going to be the evening of September 3rd. And so I want to invite all of our New York audience or people who are traveling there for that Venture Summit to come to our drinks night. And we have David Ewing Duncan. He's a top journalist who wrote the pioneering work on the measured human movement, where people are constantly measuring all of their vitals and they're getting their blood tested and comparing and measuring this over time and trying to boost optimum health. And he's going to talk about what that means in the modern age, David Ewing Duncan. He's also run a conference group called Arc Fusion as well in the past. So he'll be talking to us about that. So this is Tuesday, September 3rd, and you can find it on my Eventbrite page, stephenwardell.eventbrite.com, or email me and I'll send you the link to that event as well. Alex, any conferences, and for our audience, any conferences you want us to talk about? But Alex, any conferences that are coming up that you think are great, or people should go or not go, or they're relevant to a subsection of our community?
I think some of the audience, I'm pretty sure Melinda will be there speaking as well. And I'm not sure who else is on, but I will be speaking at the Digital Health and AI Innovation Summit, which is in Boston in early October. I haven't been to this one yet, but respect and like the people there. And I think you had mentioned that people are already starting to talk about health. So I could offer a 30-second. I will almost certainly, because it's LA to Vegas, go for a couple days or a day or two. I don't know if I'd buy a ticket, but it's just one of the denser places to see people in the space that you've already know, or to meet new ones. So depending on, for the audience, what you're trying to achieve, going there, I was there last year with Mayo Clinic. It was very productive for us trying to meet early stage companies. And so, certainly to be around it if it's convenient, and maybe attend depending on, what the business objectives would be. So, people are already starting to think about that one in November, I think, right?
Yeah,
Or maybe late October.
that's great. Yes. So health this year is late October, and people are already talking about it, and they're even talking about uh, rooming with each other. That's one lively discussion that I have seen is people talking about how to rent the biggest house in within 20-minute drive of the Las Vegas Convention Center, and then have beds, sofas,
So just like
couches.
about someone's going to go on Airbnb, rent a big thing, and then rent out the rooms again on Airbnb to
Yep.
the other guests. Yeah.
Although
That's
it's
an
less
entrepreneur for you.
well, this being the healthcare world, it's more getting back together with buddies rather than making a killing off of couch space or something.
No, I've done that a couple times. Some of my fondest conference memories. So Ed Cox, so I know a number of you know, and I have been good friends for a while, and we have shared the Airbnb at a couple conferences. So I wholly recommend it, particularly at places like JP Morgan or some of them where it's just impossible to get a hotel at the conference. You're going to have to travel anyway. It's nicer to do it with a friend. I imagine the hotels are available in Vegas for health. It's not that big, but I guess it's possible that they're sold out.
Yeah. Well, it is useful to start booking everything now. And it's a new venue. It used to be Caesar's. It used to be, I'm sorry, the Venetian, I think. And now it's Las Vegas Convention Center. That means it's hard to say whether there's lots of cafes outside of the building within a short walk. Sometimes in Las Vegas, a walk could be quite substantial to get out of a complex. So I'm not sure yet whether you can reliably just sit in a cafe outside and meet people. But so here's my review. I think health is definitely worth going to. So in the innovation economy, that's young company leaders and investors. So what people don't understand about health is that it's actually an investor conference, and it competes with JP Morgan. It's not a trade show, interestingly, and it's weak on the things that trade shows are strong on. And so when you go as a young company leader, there's lots of VCs. It will be and they're in meeting mode. And so they're there to meet. So it's great to catch up with VCs who said come back later. It's great to go make a list of VCs and write them all and assume they're going, and then just say, let's meet. And you'll be surprised. And the goal is to get 8 meetings a day for Monday, Tuesday, Wednesday of health. And if you do that, then it'll be very much worth your time. It'll set the agenda for the rest of your year. All of that's good. So that's the first part of it. Second is you'll find other small vendors like you, and also the big consolidators, the software consolidators, will be there as well. They'll often will be expoing. You can go by their booths. You can gather market intelligence. You can become in a good way. So what is not there, you'll find if you sell to hospitals, you won't find hospital CIOs who are your product buyers or CFOs there in general. You'll find hospital innovation executives, which is a senior staff position that is an influencer within the hospital, but it doesn't have a budget to buy tech within the hospital. And so you can talk to influencers, you can get entree into organizations, but you're not going to be able to be meeting with the hospital CIO there. At health plans, the general plan manager is often the buyer. You're not going to find them there at health, but you will find the innovation executives of health plans there. And so it's not a trade show. It's weak on the things that trade shows do. It also claims to be strong in all parts of health innovation. It's really strongest in payers and providers. It's less strong in consumer. It's less strong in tech for pharma. And so also consolidator executives. This would be the head of corporate development at the big consolidators. They're starting to go, but there's less of them as well. So this is really a place to meet VCs in general, and it's trying to expand beyond that and be more than that. But in general, it's a place to meet VCs. So it's worth it to go. And in fact, some people go to this and then don't go to JP Morgan a couple months later. And I believe that the health company positioned this health conference a couple months before JP Morgan, so that you would attend this and then spend your budget on this, and then you wouldn't have any budget left and you stop going to JP Morgan in January. So any other thoughts? So we have Renee writes, would love to connect with you. at health. So that's great. Sorry, this is Renee, R-E-N-E. There's also Renee, R-E-N-E, a man, who writes, I find ChatGPT is like a recalcitrant teenager. It will commit sins of omission, but will fess up if you press it. I've found it important to ask it to provide references or just the provenance of its information. Yeah, Renee, I found that too, which is I will ask it for who are the competitors of these three companies, and then it will name three competitors. I wanted it to name 10, and I'll look, and I'm slightly disappointed with the three competitors. I can think one of them is probably not quite right. They didn't really understand me. I press it for more. It gives two more. I'm like, well, why didn't you give 5 at the beginning? And then I press it for even more, and it doesn't have any more. And I'm like, but I know there's about 10. And that is anyway, but this is like early Twitter where you loved it and then it disappointed you. And so you sort of love your Chat GPT and then it disappoints you and now you're hurt, but you wouldn't be hurt if you didn't love it. So anyway, but Adam, any thoughts about those?
On ChatGPT, well, I have a 12-year-old, so not quite a teenager, but I think it's apt. My take on ChatGPT is I would treat it like a collaborator and editor. So if you write something, it's really good at shortening it. If you do, if you ask it stuff, but you got to have some domain knowledge, it's not yet functioning on its own. So like you said, Steve, you have some sense of who the competitors should be, so you know how to process it, but it's much faster to ask it for a list than go compile. And then everything you said about health, I agree with. I think it is light on pharma. There are pharma folks there, but they're the ones like us trying to build, for the most part, digital products, not pharma as a client in either the upstream or downstream segments as much, and don't see a lot of consumer stuff. But is very strong in tech for hospitals, physician groups, and tech for plans, but not necessarily the decision makers. The one pitch I'd make, and it took me a long time to learn this as an early CEO, so people can discount it, but it related to health is, particularly for the CEOs out there, it's really helpful to know other CEOs working on similar stuff, but not directly. It's helpful to know the competitors for a different reason, but someone's struggling with some of the same stuff. You hear some stories, you get some pattern matching, you can learn about investors, you can learn about sales. So if nothing else, networking with folks building similar companies in other areas at similar stages, I think I'd make a recommendation to all of us to do more.
That's great. Thanks. And lastly, before the second half of our show, just personal notices, any things you're doing, are you appearing on TV or are you, so in my case, for our New York-based audience, I mentioned before, Tuesday, September 3rd in New York in the evening, I'm doing a New York Health Innovation Night where I'm the host and invite all of you to come and meet our guest of honor, David Duncan. And for that, you can go to stephenwardell.eventbrite.com to register for a ticket. That's coming right up. Looking forward to that. I'm looking forward to meeting you and our audience who are New York-based at that. Adam, any personal notices?
Yeah, the only pitch I'd make is, as you mentioned, I'm the publisher of a newsletter. It's called Bearing on Health, like Digital's Bearing on Health. So BEARINGON.health. So grab that domain. And it's kind of bi-monthly, and we tackle one topic per newsletter around digital's impact. So there's actually a new one coming out next week, and the topic will be how is digital health impacting provider access. And so, would love any of you who want to subscribe. It's right on the website. And if you have interest in writing for us, we try to publish the topics that we're coming on, and we solicit, insightful pieces. So you get a little bit of ours, but really try to get 5 or 6 smart people about the topic to get their opinion. We do a survey, so we'll publish that. So just invite you all to join and become readers.
Great, thank you. Yeah, definitely sign up for Adam's newsletter, bearingon.health. Great, so now the main topic of our show is providers are winning digital health. And so I seem to remember there's been a 15-year period where people thought that technologists who wear black turtlenecks, not white coats, were winning digital health. And so this is kind of a shock. This is contrarian, and it's shocking. It's just shocking. So Adam, you put a lot of thought into this. Tell us, what do you mean when you say providers are winning digital health?
Yeah. So first, I love that idea that, technologists were going to take over healthcare. And my take is essentially what you said, which is, I think there are a couple technology-driven folks who have made real impact, but I think providers are winning. And the evidence I'd give is twofold. One is, if I look broadly at digital health companies that have scaled, that have built, substantial businesses and made substantial impact, all of them, but a lot of them actually are providers, right? So we talked a little bit about how digital therapeutics as a tech-only solution hasn't made it, and companies that looked like they would scale nicely, even went public, haven't. Some of those companies actually pivoted to becoming virtual care. They hired physicians, they got doctors' offices, they're billing CPT codes. So first, the digital companies that are winning, even within digital, for the most part, in my opinion, look like providers. And then I think, and we can talk about the reasons why, there have not been a technology that has dramatically disrupted healthcare in such a way that like this technology company now owns a piece of the healthcare business. There's a lot of companies who maybe are selling tech to providers, but if I think about it, the providers, the hospitals, the systems are still the ones delivering care. If we thought about who's capturing the majority of that $4 trillion spend, it is still providers, whether those are the hospitals or the physicians. They're enabled by technology, but they're not technology companies who have captured a huge piece of that. And so I think we can talk a little bit about why, in the sense of how long it takes for technology to get there, the chance to catch up, that it really is a service business, so it's hard to disrupt with pure tech. And then the last thing I'd say is, having had the good fortune to spend some time working with the Mayo Clinic platform, and now with Baylor Scott and White, the leading health systems are doing tech as well as we would do tech in the tech side. Now, they're not innovating, but they're implementing it. They're agile. They have the same talent that we would have. And so I think, to me, it's pretty clear that the providers have sort of subsumed it in, as opposed to getting conquered by the black turtlenecks, if you want to keep your metaphor.
That's great. And for our audience, feel free to ask questions in the chat as well. Yeah. So we have not seen an Apple of healthcare or a Microsoft of healthcare. The closest, could be, it's considered to be Epic, Cerner, McKesson, that sort of thing. But we haven't seen, a young generation company really rise up, take over as a pure software company. And when you get down to it, when a software company goes and tries to sell to providers or employers or payers, it's just so hard to sell software to them. And in other industries, you better buy the latest software for its efficiencies, or else you'll get wiped out in your region by someone who does. But apparently not in healthcare, maybe. Why is it just so hard to sell as a pure software company that's not also a provider, to sell to providers?
I think it's hard to sell to providers for some obvious reasons. I mean, it's a regulated industry. The way that things are bought, the expectations. So that's maybe the most obvious. Capital budgets are done annually. They're hard to move. It's a physical plant intensive kind of business. So I think those are the natural ways. I think a couple other things historically about healthcare have made it hard. At least the provider side, not as much the plan, but the provider side. The big ones have tended to be kind of academic structure. And so there's not a single point to buy a technology once and scale it. So you end up with, all right, I'm going to sell my technology into the cardiology group, show that it works, and then I'll try to get it into oncology. And so the process by which you get to scale is hard because how the decision makers go. I think the other thing that contributes to time and sort of the capture it quickly and grow big is often the outcomes, not always, but often the things that you're improving when you sell tech to healthcare providers take longer. It's not MarTech where it's very quick to be, okay, if I can get you a customer faster, I'll win. It's, first it takes a while to get a patient in, and often then we're thinking about outcomes that handle over time. So just the cycle time of it is hard. So I think that's why tech, but Steve, I think if we step back, when I say providers are winning, if you look at something like retail, right? I think we'd all say Amazon won, right? Like now, what Walmart and Target have pushed back, but that was a tech company that conquered an industry. It wasn't like they won by selling tech to Walmart or Target. They just went after it. I think if you look at finance, and you would know this better, the banks, mostly existing banks, but there are some like tech first banks that have done well and scaled. We don't have any broad national scaled providers that were tech first. The closest you may have is like American Well and Teladoc, which we could talk about how they're doing, and they're important companies, but total revenue, maybe other than Teladoc, is relatively modest compared to even the local hospital next to you. So, one is it's just hard for tech to get into healthcare, but it hasn't been an industry where an entrant has come, changed the way you deliver something and won. And I think in large part that's because it takes so long for tech to win that basically, the incumbent has a chance to adopt those playbooks, to co-opt them, to change whatever the right to become modern, whatever the verb you want, and do it at a pace before they can get disrupted completely by the new entrants. And so it's just a longer tail. There are nonprofits in there. They don't go bankrupt as much. There's, it's really, really complex. So it's hard to win. And so I think what you saw is less of, a digital first provider disrupt big systems, as the big systems have figured out more or faster how to incorporate this where needed. And so that's why they're winning.
That's interesting. So, what I'll add to that is that this whole idea of digital health, there's a special angle that I have to the definition of it, which was that you had healthcare and technology, and the technology was not in healthcare, and the people who worked in healthcare couldn't do the technology, and so you needed outsiders who could do tech to come in and do that tech. And it could be mobility, or it could be SaaS, or it could be one of these major trends, and that there was this short opportunity for those technologists to go and figure out the industry and then run away with leading this new tech development. But it was just so hard to sell into healthcare, so slow to move in healthcare, that over time, other tech companies would enter as sort of arms dealers, and they would deal in arms, selling them to payers and providers, and it allowed those payers and providers who in the past didn't buy technology didn't hire technology people to work internally well. Suddenly they have the tools to do this, so they can. An example would be some companies trying to be technology-led telehealth providers, and then Zoom coming along and offering Zoom calls to physicians, and physicians being willing to change their behavior to do calls from their basement using a Zoom call, as long as it's HIPAA compliant. And so the providers are protected by regulation and able to adopt these tools. Another part of that is that I think the term digital health is a transitional term, and I've been saying this for a while, and it describes this transitional period of time. So we used to call we used to have a work phone and a home phone, and then we had this thing that we would call a cellular phone, or a smartphone, or a mobile phone, and those were all transitional terms. Now many of us don't have work phones or home phones. Instead, we have our phone, which we don't call it a mobile phone or a smartphone or anymore. It's our phone, and it's a cell phone.
I'm smiling because I applied for a new credit card, which I don't necessarily recommend, and it had home phone and cell phone, and I don't have a home phone. It required a home phone number. I was like, it's not just some kid. So I think the other metaphor, I think you probably said in the past, Steve, is, we used to have digital banking and banking, and now you just have banking, and you expect the same place you go to maybe have a location or not, but it certainly has an online site. And I think digital health is a sort of a similar.
It used to be your mobile phone, now it's your phone, and it used to be digital health, and in the future it's just healthcare, and it's not going to be hard for providers to adopt the tech they need. Whereas in the past, it was quite hard for providers they were different silos, and tech people didn't work in healthcare, and you couldn't hire them to work to build your product for you in healthcare. And now that knowledge has become more diffuse.
And I think I'm going to say this without judgment. I think some of the commitment to evidence-based medicine, and then if you ask me my opinion, I'll give you whether it's good or bad, actually makes it hard to disrupt healthcare. And what I mean by that is if let's say you have a completely novel way to treat someone with diabetes that has almost no human interaction, doesn't need a clinician, it's a bunch of devices, there's some AI algorithm, it's going to take you a long time, measured in months and years, to prove that, and then to actually show that. Whereas in other cases, you don't need a cycle of proof before it's accepted that it can go. The market will test it, but you can get it. So here you got to run some trial, and I'll put small t trial, and necessarily And then you've got to go confront the market to win. And that just takes a long time. And it begs that the incumbents are able to do it. And then that's without talking about, okay, so not only do you have to do that to show that your model can deliver care, but then if you want to have any chance of getting it paid for in any way that isn't just direct to consumer, you've now got to run a cycle where you got to go convince the payers to cover something. So there's just a huge push to keep the status quo, which means that it's going to be hard for anyone to disrupt it at scale. And so the challenges are there. I'm saying that in a way that's negative. Let me pause. You can respond. You can ask me if I think it's actually a good or a bad thing. But I think that's one of the reasons that it's not an industry that can just be overtaken by, people coming in with good solutions from the outside.
Yeah, thanks. Yeah, I think I agree. So Swati asks, well, first she says, what I've observed, technology is an enabler in healthcare, an increasingly important one, but not a driver. So yeah, I think that's well put. And then also she asks, and this is for Adam, what do you see as obstacles to provider adoption or deployment of digital health? And so I can actually think of a big answer there, but why don't I'll jump in with mine. So yeah. I think the biggest issue is that fundamentally, healthcare is comprised of many small markets that are all added together. Here I'll talk about healthcare delivery. And those markets, some of them are still largely fee-for-service. Other ones have moved to fee-for-value. In general, fee-for-service, which is the historic model, and it's only been really moved by Obamacare, is trying to move us toward fee-for-service, and is stalled, in my opinion. So fee-for-service does not want to buy technology, does not want to adopt digital health. Fee-for-service wants to hire expensive proceduralists and give them real estate, and then optimize for fee-for-service, and optimize billing and optimize and buy a bunch of expensive providers and have them practice at the top of their license. If they have to spend budget on tech, they would rather not. They'd rather not pay some tech vendor. They get the revenue they get from the activity, the actions that they do. They'd rather not pay a tech vendor if they don't have to. And that's part of the reason why they had to be sort of required and bribed to adopt EMRs, because if they could get away without using EMRs and using manila folders and faxes and pink called while you were out slips and that sort of thing, they were going to do that as long as they could. And then alternately, fee-for-value is literally the opposite. Fee-for-value wants to buy technology and it wants to get rid of all those expensive people. And so we're seeing a slow step-by-step adoption of fee-for-value. But those places that are still fee-for-service have literally they won the customer, they collect the revenue from that customer. If you're a tech vendor, you're threatening them and taking away margin from them with your tech. So that's and that's why healthcare was known for a long time as a place it was hard to sell technology into, and it was part of the reason for the divide between providers and technologists. So, Adam, any other thoughts on what are obstacles to provider adoption of digital health?
Yes. First, a comment. I agree with you broadly. Maybe a nuance is, I think in the fee for value, assuming that you can get credit for delivering what you need to, which is part of this legacy, but you still have to see patients for an annual wellness visit. Even I happen to think that's a good thing, but like even the fee for value, we count some number of widgets that you've delivered. In general, the incentive is to deliver care that meets certain quality with less service. And tech, historically, I think to your point, has been able to replace labor more cheaply and deliver outcomes in other categories that are of equal, if not higher quality, right? So that's the pull for technology in fee for value. And in fee for service, there isn't the same interest. But what I would say is there's a whole category of tech that providers have bought in fee for service forever. It just depends on what you mean. Like some of the earliest recall technology, some of the first major uses of telephony to remind to appointment reminders was clearly because people weren't showing up and you couldn't bill, right? So it's just the incentive structure and what kind of technology is being there. I do think, and we won't get into this, I think even in the fee for service space, one of the things that is accelerating technical adoption is just the incredible challenge of provider access. And so you have real problems in almost every category and subspecialty of delivering more, if we're crass about it, more widgets to bill for if you don't release pressure. So an example one of the major problems that oncology infusion centers have is they just don't have enough chairs for new patients. Now, part of that is there's more people with cancer. Part of that is people with cancer are surviving longer and on therapy longer. But that's a very profitable procedure that you want to get your fee for service. They are looking at digital health ways to engage people later in therapy to keep them without them having to come in, precisely so they can open up essentially a new chair in the infusion center. So I think access problems across fee for service are driving digital health, even when the incentive is to do that. To your question, I guess, was why is it taking so long? Am I remembering it correctly? Like, what are the barriers
to providers adopting digital health and tech?
Yeah, I do think regulation's a real one. I think privacy is a real one. I can explicitly say for every company that is forward thinking about tech, almost every one of them has been burned by some HIPAA breach of some type. And the problem is they overreact. And so they're probably too likely to make it hard. Yet on the other hand, from their portfolio view, you're like another one of these things that could go wrong. An example, I did some work with a med tech company, not connected. So it was just the device. And like, we want to connect the device. And all of a sudden, the cost and expectations of delivering support to have a device that is now connected in the hospital would dramatically blow out their expense structure. They'd have to raise their price, even just to cover that, even if they could design value. And you're like, why would the hospital? And you're like, well, on the other hand, this is now a device connected to their network. They got to worry about this in a very real way. So I'm sensitive to the sort of structural challenges that they have. I think some of it is the aging workforce. Like the average age of physician is something like 50 now. I mean, it's getting very old. And so like in any industry, younger folks are doing it. And then what we talked a little bit about how you don't have digital only companies winning enough to show the incumbents that they had to change as fast. You know, it was really easy for Walmart and Target to get religion about e-commerce when they, were losing to Amazon about it. If you're not losing to a tech-enabled provider next to you, you have less incentive to do it and less models of success. So I think those are the primary barriers. What I can tell you from having been inside health systems, which I hadn't been for a long time, they're starting to realize it and they're starting to try. But then if you now come back to the innovation, you got to do it inside of the system and it takes a year to know, and some portion fail no matter what. It's just slow to get it actually done and transitioned at a broad scale.
And the joke I've heard about security and privacy is that there's two phases to the modernization of Americans' health records. And in the first phase, you take all of your personal, confidential, private health information and digitize it and put it in the cloud. And in the second phase, you get a free backup in China. So
when you get what do they give you? You get your own monitoring in case someone stole your stuff and see if they're going to use it, right?
Yeah. So let's see. Let me ask in a little more detail about the employer budget. So the employer budget is really interesting because employers in America are on the hook for their employees' health care in general. And people have loved this budget for a long time because it seems like a really aligned budget. So employers, they don't want to do procedures for the sake of procedures, the way that
Right.
a proceduralist might want to. They own an employee's health costs for 7 years or whatever the number is, and they'd love to. That allows them to do something today that might only pay off 3 years from now or 4 years from now. And they're very incented to do preventative care and care that is more economical. And every dollar of healthcare cost comes out of their bottom line, basically.
Yep.
And so because of that, VCs have been steering digital health tech that's often value-based to employers for 20 years. This has been a very favored budget for digital software companies to sell to. And we have seen Teladoc and Livongo and Omada and other
And Hinge is a good example now, that's getting scale. Spring that just raised a big round. So yeah.
Multiple unicorns. No Apple has come out of this yet. Some people thought Teladoc might be that Apple, but it has not been doing so well lately. But is this an example of perhaps technology companies winning in digital health in the employer budget, or are they not even winning even there?
I think they are, but this is going to be an oversimplification, but in reality, we should probably think of the employers having two separate budgets. And the vast majority of what they buy, even from the digital health companies, ends up back paid for by their third party administrator, or if the health plan and what we call their administrative services only. So if you heard the TPA or ASO acronyms, what those are, meaning even if they're paying for it, they want it processed through the same way that they're going to process the payment to the physician or the hospital. So you're still going to submit a claim, and you're still going to then send it to the insurance company that's processing it, and then you still get paid. Now, the employers have more flexibility to run things through that than you could if you went to like a fully insured book at a health insurer, but they still do it that way. And so every one of those companies you just noted started on the other piece of the budget, which is called the programmatic spend. So think of it as there's two budgets. There's a fixed amount of money that someone probably in benefits, sometimes in total rewards, has to decide to spend on things. And then there's this amorphous budget that everyone's just tapping when claims come in that they're processing and paying, and they have an actuarial account for what it is. And it is very, very common for any of those companies to succeed to start on the programmatic spend, but very quickly they hit a roadblock because those budgets are actually pretty limited and cover a lot of things where the employer will say, and this is great, but I need you to bill me through a claims. And so early on, if you remember Livongo, one of the big things Livongo solved for was how to get paid in claims. And what you see these companies end up doing is they're either sort of creating new codes and figuring out how it is, and sometimes they go, or the more successful ones are figuring out, okay, I'm going to charge you a small PMPM against your fixed budget, but then I'm going to bill you the actual physical therapy thing if I'm Hinge, for example, in the same way. Or if I'm Lyra, small PMPM, but then I'm going to bill you the same behavioral health service as I would if I were any other provider. And so they're winning, but they're not really winning other than they have an into the employer, and then they end up looking like a provider anyway. And then they end up having to compete against all the established capacity that was there. So the few that have gotten to scale have had some innovative way to do it, can get the employee into it, and then typically in spaces that aren't being attended to. So there's just not enough supply of mental health professionals. So if you're doing it in your spring, it's one of the reasons you win, not to mention they have a good service. But if you're Hinge, you've got a unique way to prevent surgeries that matter to employer, but you're still billing physical therapy, if I understand correctly, in most cases on the claims piece. That programmatic budget is very small. And the employers have to mix it between what I would call I do this to become the employer of like record, or one that you like. So I'm going to check the box. You like me as an employer. It's my benefit side, my employee perk side, and then things that cover. So it's an amorphous budget that they get to spend against a lot. So if you're a good salesperson, you have a good pitch, you can win it, but it's not that big broadly, and it's not that replicable in practice across other employers unless there's just a way for that particular piece.
So it started with software companies trying to win bits of that programmatic budget, and now it's turned into more almost provider type companies making specific provider claims.
Exactly.
And then
they're virtual care providers for the most part. Because you can win in the programmatic budget for a piece, but if you ever need to bill a claim, for the most part, unless you find some creative way to have it as a bundle or a particular device, you're still essentially submitting codes for people with certain licensure for a certain amount.
And for our audience, now is the time to ask any last questions. And so now with digital therapeutics, this is another intriguing area. And the way I like to look at digital therapeutics is, I think it's going to look like med tech, but it's also going to be just another product in the pharma sales rep's bag as well, I think, in the future. But so in the story of therapeutics, first we had small molecules, and small molecules are things like aspirin, and you can take them orally, and then you have a small molecule that goes into the blood and finds and interacts with pain processes that are happening. Then you have large molecules. Large molecules are things like your body is lacking growth hormone, and so you can take growth hormone in the form of large protein molecules injected into your blood. You can't take it orally, but they do very different things. You wouldn't expect a large molecule to do what a small molecule can do. It's a different modality. It's a totally different modality. Then there's gene editing, and so you might have lack certain genes that then cause you to have a disease, and gene editing can give you those genes back. And so this is another modality. And I see digital therapeutics as another modality, and you'd expect software to help in certain ways that you could never get a large molecule or a small molecule or gene editing to work. And you'd expect that to be consistent with cognitive behavioral therapy, for example. Software could provide this, or you could expect it to play a big role in neuro, for example, as software. And so that's the promise of digital therapeutics, that we're going to have the software that could be strong in areas that molecules can't be strong in, for example, and that can and digital therapies have an even bigger promise, which is that they can contain within themselves adherence boosting, and they can try to solve the whole problem, and they can be always on, always within arm's reach, always charged, always social, always connected, in ways that molecules can't. So, but why haven't they taken off then if they're so awesome? And you're a great person to ask this question because you've been able to marinate in that sector for a little while.
And this may be controversial, so hopefully someone on will push back. But I actually don't think it's an appropriate metaphor to compare software to any of those sort of pharma structures. The obvious reason is the IP structure is just entirely different, right? Those are sort of, you can encapsulate that in a single thing. You can get protection on it, and you know that thing is what you do versus not. And software is multifaceted. It's really hard to know like what's distinct in this versus not. And so I think just the idea that it's going to have the same profile from a product standpoint, I think it is probably missed. But probably more interestingly is the mechanism of action of almost all digital therapeutics is the same mechanism of action that people are doing in person, right? CBT you could do, right? It's just, we're just saying we're going to do it more efficiently. Now, there are a couple digital products that are, really interesting because they really do have a distinct mechanism of action. There's some stuff people are doing with eye health where, the phone itself is actually training and like reconstituting the nerve. But most digital health, whether it was coaching or CBT, it's not a distinct mechanism of action that has a proof point behind it, can be demonstrated to work, can be protected, what I just said. It's what any clinician would do. And so the value prop is not something distinct. It's just a different form factor for delivering what a great therapist would have done or a great coach would have done. And I think that was really valuable. And I think there's a lot of room for that, but it looks more like automation of human beings or complementary to human beings. And it looks like a pharma style thing that has a distinct biological mechanism of action. It works or it doesn't. It's delivered in a unique way or not. And so I'm not sure. I think we did ourselves maybe a disservice, or at least, we oversold the idea that these should be thought of as therapeutics in that sense. And I remember early on at one of the first digital therapeutic conferences, we had a debate about whether these are better thought of as parallel to care, and they're just, automations of care. And that doesn't mean they're not valuable and payable, or should they be thought of as therapeutics? I will say I've always thought of it as the care side. So I'm happy to say there's valid reasons on the other. And, some of this is confirming the bias I've had for a decade. But like at Canary Health, while we would call ourselves a digital therapeutic, this is back before you had to be a prescription digital therapeutic and had to go that route. And so we very much sold it on the idea that we could get reimbursed by a CPT. And even Omada and Sean Duffy, who coined the phrase, have moved away from it, not because they do something different, but because he's still in the model where they're trying to bill it as a CPT and a complement to people. And early on, it just meant a way of doing things. Digital therapeutic meant a way of doing things. It didn't necessarily imply the business model prescription. I think it makes sense to call it that. But there's been this sort of debate within us for a decade and a half about which of those modalities is more representative of where we're.
Interesting. And so Renee writes that he says employers realizing that they don't want to buy digital health products on a PMPM basis. They want to buy it using metrics of engagement. Thanks for that, Renee. Yeah. So interestingly, that's an opportunity for challengers is to have a financial innovation where they might offer a similar software product to incumbents, but to price it on a success basis in some way, as opposed to a PMPM basis. Employers definitely want to pay for outcomes. Incumbents don't want to sell that way, but challengers.
I'm going to challenge you on that. I think they want to pay for engagement. So I agree with what Renee is saying, but that doesn't look that different from like a monthly subscription bill, right? And it's not that different from in classic, we bill you only when you show up, right? So like that doesn't, that's different from a PMPM, but that's not, in my opinion, materially innovative to say, okay, you're only going to pay if someone logs in. The way I describe it is they want to pay you on metrics that prove your software is being used, but they're metrics you have. I've seen very little appetite in practice to have them pay you on metrics that they have to go collect and report back to you. And there's two reasons. One, relatively obvious, which is really hard to do the work of like attributable contribution. Now, in some cases you can, but you get smaller diseases, bigger no, and like so. But in general, if you've got a diabetes program, there's so much else going on to claim that you did it. But also, my experience has been, even when you can do that, the groups don't want to do the work. Like, it takes some actual work to go back and collect that and repeat it. And it's 6 months later. And it's just, and often the people buying it aren't the ones who control the data anyway, whether it's the employer, which almost never controls the data, or even the plan themselves. And so, while my experience, and to the vendors out there, everyone wants to know you're willing to go at risk. And maybe they'll put a small like success fee, but in practice, no one actually wants to do the work to put a significant risk-based contract in for someone who's got a point solution in one condition.
Yeah, thank you. Yeah, and so by the way, I remember once on a Teladoc analyst call, they talked about how they wanted buyers to buy with an access fee and a usage fee. That's the traditional way to buy telehealth. And then there was a trend to pay based on hitting utilization marks, a different way to pay. And all of a sudden, when they were selling to large enterprises, large employers, they were asked, give us your contract the standard way, and then tell us what your terms would be. Do you guarantee you get utilization? Show us how you'd be paid by utilization. And so they did all this work to provide this second contract to buyers. And then almost none of the buyers bought the new way of buying. They all bought the old way of buying. And the reason was that if it was too successful, then the buyer would have to shell out extra cash. Yeah. That would make the HR manager look bad inside of their department, because maybe they achieved goals they wanted to achieve, but all of a sudden they're blowing their budget. And so they want to know in advance what it's going to cost and not have a risk it's going to cost.
So what I can tell you is you will see a penalty fee. So you could see that I'm going to pay you this, and if you don't achieve certain levels, you're going to refund me a certain amount.
Yeah.
So it's like part of the service level agreement almost.
So Swati says, I've been saying all along, the pharma analogy doesn't make sense to apply to software. Another reason I would add is software isn't something that is invasive versus a pharma logic is invasive. So any reaction to that?
Yeah, I think that's right. I mean, I think, the point she's raising is the form factor is materially different, and that feels different as well. So it's one more reason that I think she and I agree. It's not the right metaphor, but obviously very smart people take the other side. So it's a legitimate debate.
And Renee also adds, I agree with you, Adam. The onus, I think it means the onus for having good data about outcomes. The onus can't be on employers, and certainly not on the vendors whose incentives are at odds with the employers. So interesting. Thank you, Renee, for that. Well, good. Well, so I think to sum this up, the insight I've taken from the way that you framed this idea here, but it is that there are sectors where tech wins. Amazon wins in retail. Uber wins in logistics or something like that. And when tech wins, it moves so fast into a position of leadership that incumbents can't respond. A large sector of the economy where it's going to wind up moving slowly and where incumbents have maybe unfair advantages, then that's going to be healthcare, where you need a medical license to practice medicine, and people aren't going to just switch their care away from their local primary care physician and to a national virtual only medical practice, or at least not quickly or whatever. And so if adoption takes a long time, then incumbents can leverage their advantages and win in the long run. And so we may be call this round two. We're in round two, and the providers are winning digital health. So any last thoughts on that?
No, I think that's absolutely right. I mean, I think that the chance that changes is if something materially changes in the regulatory or payment structure so fast that it opens up an opportunity for a tech company to respond, right? If tomorrow, and I don't think they'd ever do it, Medicare said, we're going to stop all this, we're going to reimburse for everything the same, at whether it's completely virtual or not, maybe you'll see it. But in the model that the payments have been relatively stable, even with some change, what we think of as care delivery is relative. It just is not easy to disrupt, and means that a tech company, your point, can't do it fast enough. Interestingly, I haven't done it, but I bet, again, I really like what you said. It's a $4 trillion industry of industries, right? There's not one healthcare sector. Like, there's $100 million sector that's like, home health, right? So there might be very big categories that are bigger than other industries that we just said that are going to be disrupted, but broadly the hospital, major provider space won't be. I could see, elective eye surgery getting disrupted by, robotic centers that are doing this because it's a cash pay, but that, and that could be a very, very big business, like it's $1 billion sector, but it's a small piece of broader healthcare. So we'd never say they want healthcare; they want a piece of it.
Okay, great. Thank you. Well, I think that's a great note to end on. Adam, thank you very much for coming on the show.
Oh, my real pleasure, Steve. Thank you. And thank you to everyone who joined us. Really appreciate the time.
And you've been listening to Digital Health Investor Talk with host Stephen Wardell, and special thanks to our guest, Adam Kaufman. We publish this show on Apple and Spotify as the Digital Health Investor Talk show, and we'd love to have you subscribe. And for our New York audience, come to our drinks night coming up Tuesday, September 3rd in Chelsea. Check out my Eventbrite page, stephenwardell.eventbrite.com, to get tickets. Thank you. And thanks again, Adam.
Again, my pleasure. Thank you, Steve.